Hey there, Alisada here. Today I'm going to be covering how inflation and the Fed may affect the market, your trading, and what potentially may lead into a recession. Not trying to scare anybody, but as we walk through this, you're going to understand why I said that. All right? So stay with me until the end because I'm going to share with you a guaranteed way to receive a 7% return on your investment. Guaranteed, right? Risk-free way. So before we start, I'm going to ask you to click on that like button, which helps me tremendously, and you, because I'll be able to make some awesome videos that in turn will make you millions on your trades, all right? Guaranteed. It would be great if you subscribe also and write comments because I will answer them, all right? So let's talk about first topic here on J Powell, all right? So for months, J Powell has beat the transitory inflation theme. I'm sure you heard about it. I mean, it made sense because the rise in prices were a factor of supply constraints that were due to equipment and worker shortages. And basically, the FOMC believed that they were going to be temporary. They kept talking about that these constraints would end soon. And again, most of the FOMC committee, believed it as well. But as time passed, inflation kept rising. In a testimony to Congress recently, J Powell made a dramatic change by raising the expectation that bond purchases would be reduced faster than expected, and so much so that he even decided to ditch the word transitory from his vocabulary.
So I think the word transitory has different meanings to different people. To many, it carries a sense of short-lived. We tend to use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that word and try to explain more clearly what we mean.
So that clearly was J Powell's mea culpa moment, and it will probably be in our economic textbooks forever. This may even rise to the level of Alan Greenspan, if you remember him or read that in your economic textbooks. And basically, when Alan Greenspan talked about irrational exuberance, where the market was. Well, 4 years later, the market topped, all right? So it took 4 years for the market to top before Alan Greenspan made history there, right? On the other hand, let's hope that it won't take 4 years for inflation to subside. They are talking about inflation lasting longer for a longer period of time, but we'll see. All right, so let's talk about inflation. Based on the November 2021 Consumer Price Index, prices climbed 6.2% over the past year. That's the largest increase in actually 31 years. That's major. Higher prices were found in energy, shelter, food, and new and used vehicles. This is the stuff that we all have to buy on a daily basis, right? Or continuously. So if you take out food and energy, the increase was about 4.6%. And that report is called the CPI inflation report, or inflation index, basically. So keep in mind that the Fed's target is 2%, and that's been the Fed's target for a very long time. New vehicles now are 9.8% higher compared to 12 months prior. And over the past year, food is 5.4% higher, and shelter costs are up by 3.5%. So to keep it in context, if you go to the grocery store and you buy $100 worth of groceries, it's going to cost you $5.40 more. It doesn't seem like a lot, but if you're on a fixed income or lower paying jobs, it's painful, right? It's really painful. So inflation occurs when prices rise higher than the wages that you make. So the paycheck is not keeping up with the prices that you are paying. It's not that bad now, but if it's allowed to continue and rise dramatically, it can destroy an economy like it did in Venezuela in 2018, where the inflation rate went to 1,000,000% a month, causing the economy to collapse, forcing citizens to flee the country. So yeah, it can happen, right? But I don't think it's going to happen to that extreme here. In 1981, however, the federal funds rate was 20%. Today, the federal funds rate is 0. Okay, so it got up to 20% in 1981. But it's not so far-fetched that interest rates could go up higher from here, could go up much higher from here, actually, if it's not taken under control. On the other hand, when prices decline throughout an economy, it's called deflation. That's what happened in the crash of 1920s, right? Economists warn that deflation could be even more dangerous than inflation. I do believe that after we solve the inflation issues that we have today, we will again start heading towards disinflation. Even now, based on the rate of inflation, our current interest rates we have now are negative, basically a relative basis. It's basically because of the inflation rate and the lower interest rates that we have. So when there is deflation, consumers may delay purchases in the present while they wait for prices to decline further in the future. And if left unchecked, deflation can diminish or freeze an economy's growth, which can freeze the entire economy overall, right? And again, that's what happened in the Great Depression. So let's talk about hyperinflation. Economists define hyperinflation as when prices rise by at least 50% a month. I've heard others say that our inflation trajectory may reach hyperinflation, and that's just nonsense. We're nowhere near hyperinflation condition in the US, okay? However, there may be a risk of stagflation. Now, stagflation, even though it's still a low probability, in my opinion, it can occur when inflation remains high and the economy is not growing. Today, our economy is growing. Again, stagflation would include rising unemployment. We don't have rising unemployment, and basically demand that is dropping. We have a high demand in our products and services, all right? This could happen if the economy moves into a recession, however, all right? And that's what I'm talking about as far as a policy mistake. There is a scenario where the Fed cannot control the growth of inflation and therefore must raise interest rates to fight off that inflation. But the Fed, in this case, really can't do anything about supply constraints. Those are issues that individual companies must resolve and potentially with the help of government. So raising rates won't fix anything, basically. So the last time that the US experienced stagflation was in the mid to late 70s. And people say, oh, we could have a scenario where it's like the 1970s. I just don't think so. In the 70s, basically, the higher prices were from OPEC, so oil was really, really high. And while a recession lowered GDP and increased unemployment. So all those things together occurred, right? And I'm not saying that it can occur again. It could. However, the conditions that we have today just don't point to an economy that's based on stagflation. At the time, Ronald Reagan called it the misery index because basically we had much higher interest rates and they were moving higher and a high rate of unemployment. And today we have a low rate of unemployment. So what really causes inflation? There are two ways. The two ways are demand pull inflation and cost push inflation. Both are the result of supply and demand. Demand pull inflation is when demand for goods and services increase, but the supply remains the same, and the cost push inflation is when supply of goods or services is limited in some way, but demand remains the same, pushing up prices. We have both today. How is inflation measured? Well, the U.S. inflation rate is measured by the Consumer Price Index, the CPI, the Producer Price Index, PPI, and the Personal Consumption Expenditures Price Index, PCE. We have three because no one index captures all of them. The Bureau of Labor Statistics calculates Consumer Price Index monthly based on the changes in prices consumers pay for goods and services. The CPI uses a basket of goods approach where it tracks changes in the cost of 8 categories that people spend money on. These categories are food and beverages, housing, apparel, transportation, education and communication, recreation, medical care, and other goods and services. The CPI is especially important because it's used to calculate cost of living increases for Social Security payments and for many companies' annual raises. It's also used to adjust, in some cases, inflation-protected securities like basically Treasury inflation-protected securities, which are TIPS, okay? And this is the guaranteed 7% interest that you could get, and we'll talk about that in a minute. The Producer Price Index is also published by the Bureau of Labor Statistics, and that tracks the changes in prices of companies receive for goods and services that they sell each month. Costs can rise when producers face an increase in tariffs, higher oil and gas prices to transport their items, or other issues such as the impact of long-lasting pandemic environmental changes, like a rise in hurricane, wildfires, and flooding. The PPI plays an important role in business contracts. Businesses that enter long-term contracts with suppliers frequently use the PPI to automatically adjust the rate that they pay for raw goods and services over time. Otherwise, suppliers would lock themselves into years-long contracts rates that might lose them purchasing power over the long term. The Personal Consumption Expenditures Price Index, PCE, is published by the Bureau of Economic Analysis, which considers a broader range of consumer expenditures, like healthcare spending. Like the CPI, the PCE tracks how much consumers pay for goods and services in the economy. It also updates the baskets of goods and services it uses for calculation based on what consumers are actually spending money on each month, rather than limiting the data to a fixed set of goods. The PCE is the Federal Reserve's preferred measure of inflation when making monetary decisions. So it's very, very important. So let's get back to talking about what's happening with inflation today. Inflation basically is not looking transitory. It's basically looking more permanent, right? One of the Fed's key role is to keep price growth stable. The Fed officials have been telling anyone who will listen to expect higher inflation in the near term as the economy gets back to normal. They're also saying that current inflation pressures should give way to a more healthy price growth over the longer term. However, Fed officials have admitted that inflation has persisted longer and higher than expected. Now, we've all heard this. Workers are especially feeling this thing, saying that higher prices will moderate once the economy gets back to normal is easier than actually living through the increase, especially as October wages only gained 4.9% from the prior year. Inflation was higher than the wages that people are receiving. We are seeing supply constraints easing, and there are pockets of prices dropping. For example, airport prices are down after peaking in June, now 5% cheaper than October 2020. Yet overall inflation is moving higher, so something else is going on too. Supply chain issues continue to mess with prices. Take used cars and trucks. While prices declined as the economy went into recession, it's not the case that used cars and trucks became cheaper than they were in February of 2020. In fact, they've never been more expensive. Supply is limited thanks to new car production, due to ongoing chip shortages, people hanging on to their leases for longer, and rental car companies having fewer cars to unload after limiting their inventory when the pandemic struck. Plus, people who put off buying cars last year are suddenly competing for cars today. Labor issues are also still a problem. Millions of Americans lost their jobs or left them voluntarily during the COVID recession, which resulted in a lot less stuff being produced. Businesses have had a difficult time throughout 2021 hiring enough workers to satisfy demand, and labor force participation is 1.7 percentage points lower than it was before the pandemic. So basically, there's a lot less workers out there, that are in the workforce today. And there's actually a lot more work to be done on that front. Let's talk about how to beat inflation. And this is important. So from 1920 to 2020, the S&P 500 generated an average return of just over 10%, with dividends reinvested. This is a long-term average, as you all know, and in some years the S&P 500 had lower returns. Okay, sometimes we had recessions and we had negative returns in the S&P 500. Another way to stay ahead of inflation is the Series I savings bond backed by the U.S. government. The initial interest rate on those series bonds is 7.12%. I mean, that's a lot. Basically, you're getting a guaranteed return on your investment. However, the downside to that is that you can only buy, as a single person, $10,000 worth, or as a married couple, you can buy obviously $20,000 worth. But still, you get a great return on that, and it's guaranteed. That's probably the most solid return that you'll ever get. On the other hand, the best way to beat inflation is for you to join my trade alert service and trade SPX credit spreads. This year we netted over a 60% return, beating the S&P 500 by a very wide margin. And yep, that was a plug. Okay, so should you be worried about high inflation? I think so in the short term. Maybe because there is a chance that Powell takes a more aggressive approach in raising interest rates. Other than that, we should be fine. If you review the inflation trend since the 1980s, it's clearly moving lower. To give you a perspective, here's a chart of the 30-year Treasury rate since 1980. If I was a betting man, and I am, I'd stay short. Now, there is a risk that the Fed may cause a policy error. It has happened before, and as recently as 2018 by J Powell himself. Toward the end of 2018, the Fed was raising rates and signaled 4 additional rate hikes in 2019. Then there was a 20% correction in the market. Oops. Instead of 4 rate hikes, there were actually 2 rate reductions in 2019. That was a pretty drastic turn of events. But even if supply constraints continue for a longer period of time, the end result is that American firms will continue to innovate and technology will continue to evolve, creating greater productivity. All of that is inherently disinflationary, and prices for goods and services will continue to move down. So the battle now is inflation, but the war that we will be continuing to fight is basically disinflation. All right? I hope this gives you a better understanding of the stuff that affects markets and makes you a more educated trader. If you found this video valuable, don't forget to smash away at that like button. It may change your life forever. All right. Thanks, guys. Have a great week.